Hi everyone, we are doing one of the consolidation questions here. We have the format ready here. Do not worry much about remembering the format. We will be able to memorize it as we do more of these questions. And if at a later stage, if we still feel a need to memorize the format, we will do so. Um, so this is one of the consolidation questions. We will in the consolidation questions we see how much is the consideration paid, what was the net assets at the time of acquisition, then how much it is at the reporting date, how much is the difference. We calculate the goodwill, we see how much is the change in net assets, then we calculate NCI at reporting date, if there is any unrealized profit on inventory, retained earning, parents retained earning at reporting date. Then we have the statement of financial position ready here. And yeah, so let's read the questions and try to put the information into this format. The following are the draft statements of financial position of party company and streamer company as at 30th September 2015. So they have given the statement of financial positions individually for P company and S company. So, and then we have um, information here. On 1st October 14, P company acquired 80% of the share capital of S company. Okay, so they have acquired 80%. That is something we need to remember. We can note down somewhere that the acquisition is of 80%. So the NCI is 20%. Non-controlling interest is 20%. At this date, the retained earnings of S company were 34 million. Okay, so let's see where we can put this information. So retained earning of the subsidiary. Okay, so here we are calculating the net assets of his company. So retained earning at acquisition was 34 million, and we will put the numbers in thousands. Okay, and the revaluation surplus stood at 4 million. So it had its revaluation surplus, which is reserves, was 4 million at the time of acquisition. Okay, so we have put this information. Let's continue reading. P company paid an initial cash amount of 92 million. So P company paid initial cash amount of 92 million. So cash consideration is 92 million. And the revaluation surplus to P company paid on initial cash amount of 92 million and agreed to pay the owners of S company a further 28 million. So they agreed to pay another 28 million on 1st October 16. 1 year later they will pay. So it's a deferred compensation. So it will be recorded at discounted value. The accountant has recorded the full amounts of both elements of consideration in investments. Okay. So the accountant has recorded the full amount. So let me first note this 28 million somewhere. So this is a deferred consideration. So here parents deferred consideration we will put like 28 million, and then we will use the discount factor here, and that will be um, reported here. Okay, so but then it is also saying something about the investments which we are going to put in the non-current assets. So what it is saying, the fair value sorry, the accountant has recorded the full amount of both elements. So how much is the investments as per the books, as per the draft, this thing, it is 120 million as reported P company. Okay, so we will put this investment which is like 120 million, which is on the financial statements. So at a group level, because it's P's investment into S, and at a group level it will become zero because 120 is reported minus the 92 million of the cash consideration, and then 28 million of uh, 28 million of deferred consideration, which which is something which is, I mean, um, recorded by the accountant by mistake at full an investment. So this is the working section here, and here we need to update the final amount. So we can see that this will become zero. Okay, so investments we have updated likewise. Huh. P company has a cost of capital of 8%. So cost of capital of 8%, that will be, so this 8% rate we can use for unwinding of deferred consideration. We will see that. But let's remember this 8% also. The appropriate discount rate is 0.857. So discount rate we will use for this deferred consideration 0.857. Okay. So the deferred consideration will be calculated at discounted with this discounted rate. So it will become 23996, which is the present value of the deferred consideration. Okay. Hmm. All right. Then we have NCI at fair value. Okay, let's continue reading, and whenever we see something, we will put it in this format. So let's read fact 2. On 1st October 14, the fair values of S company net assets were equal to their carrying amounts. Okay, so there is no fair value adjustments. With the exception of some inventory, which has cost 3 million but had a fair value of 3.6 million. Okay, so they had some inventory at the acquisition date, um, which cost 3 million but its fair value was 3.6 million. So there is 600k, the difference between 3.6 and 3 million, 600k of fair value adjustment here. Okay, so that we are going to report somewhere here. Fair value adjustment on inventory at the acquisition date, it was 600. How did we arrive at this number? 3.6 minus 3. Maybe here we can put it, not so sure. The okay, 3.6 million minus 3 million. Okay, so we can say that we had 600 of fair value adjustment on inventory at the acquisition date. All right, now let's continue reading. Hmm. On 30th September 2015, 10% of these goods remained in the inventories of S company. Okay, so at the reporting date, 10% of the this inventory remained. So then this this multiplied by 10%. Why we are doing this 10%? Because only 10% of the of such goods, which fair value was different than the cost, and we had fair value adjustment. So 10% of such goods are still in inventory. So that means the reserve will be 10% of the initial fair value adjustment. Okay, so this will be 60. This is the net assets at reporting date. Okay, that we are doing. Let's continue reading. So now let's move on to the third fact. During the year, P company sold goods totaling 8 million to S company. P sold to S 8 million at a gross profit margin of 25%. So this gross profit margin 25% means that will be calculated on 8 million. At 30th September 2015, S company still held 1 million of these goods. So it is intercompany sale, P sold to S and 1 million of such goods. So I mean, initially they sold 8 million, out of which only 1 million it is still within the group. Okay, so we are concerned with the inventory, or I mean the sale which is still uh, within the group, and it is yet not sold to the outside party. So 1 million is the amount here. 1 million of such goods is in inventory, and their profit margin to third party customers is 45%. That's irrelevant information here. So 25% margin we will take, and 1 million of sales, or 1 million of such goods are still in inventory, still not sold to the outside party. So um, we have unrealized profit on inventory here. Okay, how much? 1 million multiplied by 25%. Okay, so we will keep it here in our working notes. And okay, we have found this information, we will put it here. So we have like 250 of unrealized profit on inventory at the reporting date. Hmm. Let's read fourth. The party group, the P group, uses the fair value method to value the NCI. At acquisition, the NCI was valued at 15 million. Okay, so at acquisition, NCI was valued at 15 million. So that we will report here. NCI fair value at acquisition. Okay, so this is the okay consideration paid. I think so. They paid cash. They have some deferred consideration to pay, which is reported at discounted value. Then they have NCI at fair value at acquisition 15 million. So sum of all this is 139 and 6. So this is the consideration paid. How much is the net assets at acquisition? So share capital of S company, we need to put it here. So from the question we can see they had 60 million of equity shares. So that was their capital. So they had 98600 of net assets. Maybe we can put this here also, net assets at reporting date. So share capital is still 60 million. Their retained earning we can see is 36500 from the question, and they still have 4 million of reserves. Then fair value adjustment we already know. So the change is 1960. Okay, we have calculated the change here already. This is also done. Then goodwill from working note one we can see um, how much is the consideration paid. Then from working note 2 we can see net assets at acquisition, and then the difference is goodwill. Then change in net assets we have already calculated in working note 2. We are just putting it here as a separate note. We can reference it from working note 2. Okay, then NCI at reporting date. So NCI at acquisition was 15 million. Then NCI share in post acquisition change in net assets. So how much is the change in net assets? It is 1960. And then NCI percentage is how much? 20%, because 80% was acquired. Okay, this 1960 I'm taking it from here and then multiplying by 20%. So this is 392 is NCI share. So NCI at reporting date will be 15392. In working note 6 we have already calculated the unrealized profit, parents unrealized profit. Then we need to calculate the retained earnings. So parent retained earning is given in the question, which is I think 210000. Yeah, so parents retained earning given in the question in the draft financial statement is 210000 at the reporting date. Then we are saying parent share in change of subsidiaries net assets post acquisition. So how much was the change in net asset? It was 1960, and here we will take 80%. While calculating NCI, we took NCI share, we took 20%. Here we will take 80%. Okay, so maybe I can reference it from here. So the change in net asset is 1960, and then we'll multiply it by 80%. Okay, so 1568 is taken here, and 392 is here. Sum of this is 1960, which is this. Okay, so what else? And then we have unwinding of deferred consideration. So cost of capital is 8%. So how much is the deferred consideration? So deferred consideration at the present value was 23996. Okay, then we will, I mean, instead of J6 maybe we can type it 23996 multiplied by 23996, uh, wait, this plus 23996 multiplied by 8%, which is the cost of capital. This information is given in the question. So I think this will be reported at 25915. Okay, 25916. So parent retained earning at reporting date would be 237. Okay, this is how we unwind the deferred consideration. And then we have non-current assets. So PP&E. So at a group level, how much of PP&E they have? So we can see right at the beginning 392 plus 84. Okay, so it will be 392 plus 84. Okay, it so the ppne will be this much. Then investments, we have already seen that at group level they don't have any investment. At individual level, P can say that I have like investments in S, but at a group level there is no investment outside. Then goodwill we have already calculated. We are referencing it from working note 3. Current assets we can take from the question. So how much is the current assets? So P's current assets is 94,700 here, and S is 44,650. So let me note it somewhere, then I will copy it. For a moment I'm noting it here. So 94,700 plus 44,650. Okay. So then I will remove it from here and then I'll put it in the current assets section. So this is from the questions, but we have some adjustments also. Uh, the PUP, like parents unrealized profit on inventory of 250, that we need to take out. And there is another thing here, which is uh, fair value adjustment on inventory, okay, which is still 60. So we will add that fair value adjustment on, because both the things are related to inventory. So we have taken the current assets, whatever is given in the draft financial statements of these individual companies, we add them up, 94,700 plus 44,650. Then we take out the unrealized profit, parents unrealized profit, and then we add the reserves, uh, fair value adjustment on another current asset. So how much is the amount? Mhm. This will be 646,556. This is the total assets. Okay, because we have taken like ppn investments, goodwill, current assets. Okay, then we have share capital. We are calculating equity. Okay, so we share capital will be of hmm, where is in the question it is given share capital equity. So 190 is the share capital. We will not add like parents and subsidiaries both. It will just be of the parent. 190 at a group level. This is the share capital, and NCI share is I mean, we first calculate equity to the parent and then we put the NCI number here. So share capital of the parent, maybe we can say share capital of the parent. Then retained earning we have already calculated. Okay, retained earning of the parent. So we have already calculated here. Then we have revaluation surplus. Okay, how much is the revaluation surplus given? In the question, it is given 4,400 of the parent. So everything of this. So I want to border it, but let's maybe I can bold it here or something. So this is the equity to the parent. Okay, and then NCI share we have already calculated in working note 5, wherein we have taken the 15 million of NCI at acquisition and added, post acquisition change in net assets share for NCA, which is 20% of 1960. So we have added this, taking it from the working note. Then we have non-current liabilities. So while we do the non-current liabilities, let's take it from the question. So they have maybe somewhere I can note it first. So current liabilities they have um, mhm, mhm, 137,300 of current liabilities plus 28,150. Okay, because this will be reported, I mean, it's liability to outside parties. So we need to add parents and subsidiaries both. So now I will take it and put it here, non-current liabilities. Okay, so this is non-current liabilities. Let me fix the format here. Number. Oh, oh. Then we have deferred compensation. So how much is the compensation that we wait a second. Uh, okay, so compensation is how much? Um, it should be 25916, which we have calculated here. Okay, and current liability. Oops, I have put this information wrongly. It should be here. This should be here, and this should be here. This should be deleted. Okay, and we have non-current liabilities. Do we have anything in this section? Okay, we have deferred consideration. So our deferred consideration is here. Okay, and what else? We have current liability. I think everything we have covered. We are doing some mistakes somewhere. Because the assets, let me not bold this one. So something I can do here to show it's a total. Mm-mm. I wanted to show it as a subtotal. Do we have a border here? Yeah. Maybe something of this sort. Not working. Maybe this one will do. Maybe I'm missing something here. No worries. So, but this is subtotal. Just be careful. Okay. Okay. Not a big deal. Yeah. So this our balance sheet is off here. Okay. Total assets is 647,556 and total liability is okay. Total liabilities and equity or equity and liabilities. Total equity and liability is 675. So the difference is 27835, which is not correct. So so what we are doing wrong here is deferred compensation. So in the non-current liabilities, yeah, so this is definitely a non-current liability that we will pay in future. Okay, so I think this number is same. So the problem is unwinding of deferred consideration. So in the retained earning, I will not wind up everything. So here is the mistake. I will not wind up everything. Wind up means the amount. I mean, oops, how much we will wind up from the retained earning. Okay, so it will be from this amount, 8% only. So this will be this much only. Okay, 213,238. So the unwinding will be of 1920. Okay, and Here we are going to do all like 23996, which is the deferred 23996, plus this is G37. Mm-mm. I mean, we know the amount, right? It is 1920. Okay. And how but two, so deferred compensation to be reported in the non-current section should be this much undoubtedly. Okay. Okay. So the present value of the deferred compensation, and then we add the unwinding here. And here in from the retained earning, it will reduce. Okay. Here it will be a negative number. Okay. So that is the thing. It will be a negative. Unwinding will not be of the entire deferred consideration that we reported earlier. It will be like just the 8%, which is the cost of capital. So we'll take 8% of the present value of the deferred compensation, and then so it will be a reduction from the retained earning. Okay, so it should be reported in as negative amount. And yeah, so this is the thing. So now our balance sheet is balanced 647,556, 647,556.